le rá a leascan cóirle inis na cólairtaí airthe se gur costais rá mhór agus míthar ar thomanairí agus ar úinéirí tithe, agus tá seothad tarlú bliain in é bliain. Tá bille seo chun sinna airthe. Tóir sé túsáite de tomanaí agus úinéirí tithe le airsacu airthas ar a tithe ag léadú costaí. Tóir sé ar chólairtaí airthais a chud cleachtaithe a bhíniu. Agus choirí me bille sa jeú le déhreisal éite bhfuil is i cólairtaí ar na customary attendees tulsena ach nuacha na dhéanú ar policy agus de bhair sin geartar price níos airde orthú. A leascan cóirle, today is the day for this Dáil to end the insurance rip-off. Today is the day for this Dáil to put consumers first, and today is the day that we send a clear message to the insurance industry that the game is up in relation to exploitative practices for home insurance and motorists. For too long, the insurance industry has been able to price gouge its customers. Most people believe that their insurance premium is based on how likely they are to make a claim and how much that claim would cost their insurer. But that isn't the whole story. In November, the Central Bank found that insurance prices have risen by 35% in the past decade, despite the cost of claims falling by 9%. We know that insurance companies are engaging in a price gouging practice called dual pricing to charge customers much higher prices than the actual costs of their policies. It involves the use of complex models to identify customers who are likely to renew and then charge them with the highest prices possible before they're tempted to switch to a competitor. So instead of rewarding you for your loyalty, they increase your premium in the knowledge that you are more likely to renew than to switch. That is the loyalty penalty. Take Ray, for example. Ray received a renewal quote from Liberty Insurance for €1,420 for his car insurance, only to be offered a premium of €680 for the exact same policy with the exact same provider when he went online. Overcharged by 109%, €740. That is the loyalty premium. That is what we are going to ban in this House. In September 2019, I wrote to the Governor of the Central Bank requesting an investigation into the practice of dual pricing. And after meeting with the Governor, the Central Bank agreed to carry out an investigation into my complaint that I submitted. In January, the Central Bank began its investigation of last year, and its interim report in December confirmed what we had said in our major complaint. That is that dual pricing is endemic right across the insurance market, that it affects more than 7 in 10 Irish policyholders, with many being overcharged hundreds of euros every single year. While the insurance industry has been allowed to rip off Irish customers, action has been taken elsewhere. Between 2014 and 2017, 20 US states prohibited the practice of dual pricing, including California, New York, Florida and many more. These bans were recommended by the American Association of Insurance Commissioners, who found that the use of dual pricing unfairly discriminated and called for the practice to be banned. In their own words, they said, two insurance customers having the same risk profile should be charged the same premium for the same coverage. And that is the principle of fairness which this legislation is based on and built upon. In Britain, the Financial Conduct Authority began its own investigation into this practice in 2018. It published its final report in September. Its findings were stark. Its solution was clear: to ban dual pricing. The British regulator found that in 2018 alone, dual pricing resulted in 6 million policyholders being overcharged a combined €1.4 million. They also concluded that dual pricing distorted competition, while others, including the industry and unfortunately including the junior minister with responsibility for insurance, have argued that a ban on dual pricing would undermine competition and deter new entrants. The British regulator, the FCA, found the very opposite to be the case. In their own words, they say, this type of price discrimination has a negative effect on competition. While removing dual pricing, they say, would improve the nature and intensity of competition. And for the benefit of the junior minister, I will quote them. They say this would mean firms competing in a more effective and innovative way, which would lead to lower overall costs for supplying insurance, more intense competition and ultimately lower average prices paid by consumers. The British regulator has responded by announcing it will ban dual pricing this year. Irish consumers deserve no less. My insurance bill will ban this price gouging activity. It will ban dual pricing by requiring insurance providers to use only rating factors directly linked to the risk to be insured, so that renewing customers can no longer be charged artificially high prices based on their likeliness to renew, their economic background, their spending patterns or any other trait not linked to risk. It will increase transparency in how your premium is priced. Whether you receive your quote or premium from an insurance company, whenever you receive that, the insurer will be required to tell you the rating factor used to calculate the price. How much of the price is to cover expected cost of claims, how much is to cover the cost of servicing, how much is to feed the insurance company's profits. This bill will ensure that transparency. Crucially, it will empower the central bank to draw up the regulations that will govern this ban, using the expertise of the central bank to remove this practice from the insurance market. Some may have concerns in this House that the central bank, not the Dáil, are best positioned to determine how dual pricing is removed from the insurance market, and this legislation answers those concerns. It will require the central bank to provide and produce a code of practice which will assist the courts and the Financial Services and Pensions Ombudsman where an insurance company has broken these new laws, and it will be required to publish an annual report assessing the industry's compliance with the legislation. Where an insurance company continues to use price gouging practice against customers, the central bank will have the power to sanction them. The legislation will reduce prices for consumers who for too long have been ripped off by the insurance industry. The Financial Conduct Authority in Britain found that a ban on dual pricing in the British market would bring real benefits to consumers, saving them between €4.8 billion and €12.9 billion in the next decade through lower prices. Using a data set of 17 million observations across 6 million unique insurance policies, the FCA have modelled what a ban on dual pricing would look like, and they have found that a ban on dual pricing would reduce insurance premiums by up to 27% for homeowners who renewed up to 10 times and up to 34% for motorists who have renewed that same tenure. This legislation provides for the same remedy, to ban this price gouging practice. Its effects would be the same, reducing prices for Irish consumers, and the Minister for State again has claimed that this legislation will prohibit discounts on insurance. Let me be clear, he obviously doesn't understand the legislation or the price remedy to be introduced here, or indeed what is happening across the water on which this legislation has been built upon. It will do no such thing. This legislation addresses the discriminatory practices of the insurance industry in the digital age. As the International Association of Insurance Supervisors have warned, the growing use of complex algorithms and rapidly expanding ability of insurers to access more data creates risks for consumers. It demands a response from legislators and regulators. As they noted in the issue paper in March 2020, pricing algorithms are now being applied to new sources, including online media data, such as web searches, online buying behaviour, social media activity accessed from third-party sources, including search engine providers such as Google and social media platforms such as Facebook. This reality was also underlined by EIOPA, the European regulator, who in 2019, where they noted in the thematic review that firms using new data sources for pricing and underwriting, including web searches, online purchases, social media activities, job career information, bank accounts and credit card data accessed from third-party sources. That is the vista before us. The question is it ethical? Is it transparent? It definitely is not. This legislation responds back to the risks posed by pricing models that discriminate and use personal data without the knowledge of consumers. This legislation will ban dual pricing. It will end discrimination and bring transparency to setting prices. It will radically shape up the insurance market and do so for the better, increasing competition, reducing time and money for consumers spend switching. Crucially, it will reduce prices. The legislation requires the industry to do what should be a given, to price fairly and to price transparency. I welcome the fact that the Consumers Association of Ireland and Brokers Ireland have supported this legislation. I also welcome the fact that the Government is not opposing this legislation, but I am disappointed that they are putting a stay in it for 9 months. While they may delay this action, they will not hold it back. Gurmaigat.